Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Cokerhook, and this is segment 2 of our conversation regarding loan modification. If you joined us last week, we spent a lot of time talking about how the ground rules have changed and who the players are with respect to the need and the possibility of getting a modified home loan, and what some of the challenges are with the complexity of the system and who the players are, et cetera, et cetera. The good news out of all of that is that there's a much greater opportunity today than there was a year ago for someone who is in a situation where they have a challenge with their home loan to be able to get modification done. What we're going to do in this segment of the show tonight is talk very specifics about what you can individually need to know and understand and can do for yourself to prepare yourself the best you can to be able to qualify for a modification. My guest again is Narbek Karamian from Bena Group Inc. Narbek, thank you very much. And actually, you're a director, are you not, for, you're going to have to say this because...
It's CAM, the California Association of Mortgage Brokers.
California Association of
Valley
Mortgage Brokers for the Silicon Valley, and you're one of their board of directors.
Right.
Fantastic. So, and one of the things that you had mentioned to me several times is that you have actually worked with a goodly number of individuals who have been confronted by this problem and helped them determine if they could qualify for something, and if they could, how best to go about it and which program they would be able to qualify for, and then help them find a solution.
That's right.
Fantastic. So what we're going to do tonight is walk through that process. I'm Mr. Homeowner, and so what do I need to do and know, and how can I get myself out of this problem?
I'm just trying to figure out where to start to make it the most efficient way. But you know, it all started with me where people were calling me for some advice in terms of how to go about it, and that created interest. So we started digging into it, and we actually found out the fundamentals behind the modification, and that's how we got involved in this. But as a homeowner, obviously there are certain criteria that's required to even be considered for a loan modification. One of them is that it has to be the subject property that's being, you know, as a candidate for loan modification has to be the primary residence. So they have to live there. It can't be an investment property. There are programs for non-owner occupied modifications, but what we're specifically talking about, which we mentioned as the Making Home Affordable program or the HAMP program, Home Affordable Mortgage Program, Modification Program, it has to be your primary residence.
But that doesn't mean it has to be a single-family dwelling. It could be a duplex or a triplex or a fourplex. Or a fourplex, okay.
Whatever that is your primary residence. So that's the first most important requirement. The other one is the homeowner who's applying for a modification, as the name states, has to be experiencing some kind of a hardship. Okay, so financial hardship. The third requirement, which is interesting, and I think we'll break it down a little bit more, is their mortgage payment, including their property taxes and insurance, if there are any homeowners associations and all that, have to be more than 31% of their monthly gross income.
Okay, say that again?
So let's say, for an example, if a homeowner's income is $5,000 a month gross, their mortgage payment, including their property taxes and insurance, has to be more than $1,550. The $1,550 is 31% of their monthly gross income, which is $5,000.
So it has to be higher than
that. It has to be higher.
Ah.
Okay? And the reason behind that is under President Obama's program, it's not what the lender wants to decide the payment to be. It's what homeowners qualify for 31% of their monthly. So in order to qualify, your current payment has to be more than 31 so that you can be brought down.
Okay, so the current payment has to be higher than that, and then you can drop it down to 31%.
The lender's job is to drop it down to 31%.
Okay.
Now there's a couple of,
I'm going to interrupt you for a second because I want to go back to something that you mentioned. The second criteria was financial hardship. How is that defined?
Financial hardship can be a job loss, you know, heaven forbid, a death in the family, a divorce, anything that creates, quite frankly, a hiccup in one's monthly financial income.
Okay.
So, you know, even the fact that home interest rates have dropped so drastically, while people have interest rates that are in the 7 or 8%, may create a financial hardship when they can qualify for a lower interest rate. So whatever that creates a small hiccup or a hiccup in a monthly income is considered as a hardship.
Okay.
And then also the loan amount cannot exceed $729,750, which is the maximum limit for government-sponsored loans.
I remember that. That's
right.
That's okay. So when you say a government-sponsored loan, that's something Fannie Mae or Freddie Mac might be able to fund.
That's correct.
Okay.
But again, as we talked about in our last segment, there are so many different kinds of modifications out there under specific investors that this number, you should not use this number as the benchmark that if my loan is $800,000, oh, I'm not going to qualify. I would bet that you would have maybe above 70% chance if you had all your numbers straight that made sense to even qualify. I've seen people qualify.
Because it may not be a government-owned loan.
That's
what
correct.
You're saying.
That's
and the other investors, as we talked about in the last segment, the investors that are actually putting the money up or have bought these package mortgages are willing to participate in some type of modification structure. Their guidelines are going to be a little different than the Fannie Mae Freddie Mac guidelines, but they do have guidelines.
Right.
And if you can understand what they are, you have the opportunity to participate.
Exactly. You may not get exactly what the government program has to offer, but I've seen folks who've had $1.4, $1.5 million mortgages, and they've gotten a pretty decent modification.
Fantastic.
Okay.
All right.
So the 31% is critical because under the Making Home Affordable program or the HAMP program, the government also subsidizes an additional 7% to that income to pay the lender. So in reality, if $1,550 is what the homeowner's income has to be at 31%, the government also adds an additional $350 a month based on the $5,000 income out of their subsidies to cover a higher mortgage payment for the service.
Okay, so let me see if I got that. The assumption is I make $500,000, excuse me, $5,000 a month. $500,000 a month would be
nice.
Great, but that's not like, I make $5,000 a month. We can adjust the loan to the point where my mortgage payment would be 31% of that value, which was the
$550.
Okay. But what I'm understanding you to say is that the federal government is throwing in an additional, was it $380?
Well, 7%.
7% of whatever your income.
That's correct.
So that to
incentivize.
But does that increase the amount of what the payment would be?
Not really. It doesn't affect the homeowner. It's just an incentive behind the scenes for the servicer or the investor to actually be more motivated to do so.
So that 7% will go directly to the servicer, which we defined last show as like BayVay, Wells Fargo, whomever the bank that's actually you're interacting with.
Exactly.
And maybe a part of it to the lender that's actually funding the money for the process.
Well, it'll go strictly to the investor who's collecting.
The investor. There we go. Okay. Thank you.
Now there's a couple of caps involved. Because obviously, when you look at a $1,550 a month payment, it really is up to the lender to determine what interest rate would they have to offer the homeowner for the payment to
get to that level. Okay.
And there is a floor cap, as we call. We have a floor cap, and we also have a ceiling. The floor cap under President Obama's plan cannot exceed 2%. So the lowest somebody can get a loan modification is 2%.
So 2% as the interest rate.
As the interest rate,
okay.
Right. And this payment has to be principal and interest. It can't be the interest only or those scary negative amortization.
I remember talking about those, yeah.
So hypothetically speaking, if this $1,550 does not fulfill the 2%, that means in order for the homeowner to get a $1,550 mortgage payment, the interest rate, let's say, has to be 1.2%. That's not going to work because they're surpassing the cap.
So you have to have
So then there's the second phase to the criteria here. So now the second phase states that if the 2% does not suffice to the new payment, then the lender has to stretch the 30-year loan into 40 years to even help in getting the payments dropped further.
So in other words, they have put in fail-safes into the system. So they've increased the probability that you will be able to successfully qualify for a loan modification, is what you're telling me.
Right.
That's a very positive thing. Here again, there's a certain level of complexity to this, and I imagine that as a homeowner, if you go up to some of the government websites that we talked about previously, and we'll show again on screen here in a little bit, folks, a lot of this is probably more clearly defined than we're able to give it in this conversation. But so the information is available and people can have access to it. If you want to know more about these things, and if you want that list of websites, send us an email at info@referencepointtv.com. We'll be happy to get that information out to you, or direct a specific question to Narbek, who is clearly the professional in having worked through and done some of these sorts of things. Now, let me ask you this, Narbek. Let's talk about this number, this income number. How do they determine what that is? It used to be that you could just state, oh, I make X $1,000 a month, and they would say, okay, fine, that's good. Those days are long gone. So what do you have to do in order to verify and validate whatever your income is?
Good question. Back in the days when we had the stated loans, which actually got us into the crisis we're in right now, under normal lending guidelines, putting aside loan modifications, if somebody were to buy a home, that applies for today as well. If somebody's buying a home or planning on refinancing under normal circumstances, this 31% is actually allowed to go as high as 45%.
So if your mortgage and associated costs can be 45% of your net income.
So if you
is that your net income or your gross income? Your gross income.
So if you want to buy a house, as long as you have no other financial liabilities in terms of car payments, student loans, and all that, you are allowed to have a mortgage to which the payment does not exceed 45% of your gross income. This also has to include your property tax and insurance. So that's how it's calculated. So that number based on your annual income might be $300,000, might be $400,000. Whatever that 45% is determines your borrowing power.
So how do I prove my income?
Those are all provided. There's a set of documents. If you're employed or a wage earner, then obviously you collect pay stubs and paychecks, and also W-2s.
Oh, okay.
So you have to provide 2 years of income, which is your W-2s from the past, and also 2 months of your most recent pay stubs.
Here in Silicon Valley, we have a very high number of people that are self-employed.
Correct.
You know, business owners or consultants or entrepreneurs. They're not necessarily going to have a W-2 form. So how do they qualify?
Right. For those folks who are self-employed, the W-2s for the previous 2 years actually can be substituted by tax returns.
Oh, okay.
The only drawback to self-employment is the number that you qualify for is based off of your net income as opposed to your gross income, while W-2 is gross income calculation.
Right, so, which is interesting because as a business owner, you're going to look to minimize your net income so that the tax liability is going to be so it's sort of it's a little bit of a catch-22 type situation there. So but if you understand that going in, you can there's ways to
you gain some, you lose some, I guess. But the one thing that's allowed though, now your lender, your bank, or whoever your broker is that's doing the financing for you will know that you are allowed to add back in the depreciation that you take into consideration. So that also helps the income to be, to boost your income a little bit. But that's what is required for the previous 2 years of income. In terms of the current year, let's say you're trying to do some kind of a financial activity, be it purchase or refinance in September. Then instead of the most recent pay stub, you're going to be required to provide a profit and loss statement or a P&L year to date.
Okay.
So that's how they prove it, and I think that's enough proof for the lenders to feel comfortable
that you're actually making some money. Okay, so we have the homeowner is looking to do a modification. They have to have a financial hardship. They the mortgage payment needs to be no more than 31% of their gross income.
That's correct.
And there was another point that I think you mentioned that.
It has to be their primary.
It has to be their primary residence. Okay. So assuming those three things actually are present, how do you proceed?
Okay. One thing I forgot, or I think we forgot to cover, was the 2% floor cap.
You mentioned that, yeah.
Right, and then the 30-year amortization into a 40-year amortization. Right. The third is, if even the 40-year amortization does not suffice, then the lender is responsible for a principal reduction of the loan to make it work under the 40-year and 2% criteria.
And the incentives that we talked about previously, the financial incentives to the servicer and the lender, are there to encourage them to take those further steps.
Right,
right.
Okay. Now, if it gets to a principal reduction and the lender or the investor is willing to compromise 10% of the 10% of the fair or 90% of the fair market value, then the other incentive is the government is actually willing to buy this loan back from them.
So let's say it's $1 million piece of property. You're saying that if the investor is willing to say, okay, I know it's a problem, we will reduce the principal to $900,000. Then the government would actually buy that loan?
Right. The 90% is fair market value.
Fair market value.
What
okay, fair market value. Got it.
Sometimes it might be a little bit
It may
more.
not be worth $1 million now. The original loan may have been $1 million. It may be worth $700,000 now. Okay.
So
understood.
Those are the three requirements, which is very important for us to know, because obviously those are some of the determining factors when you talk to the bank or the servicer. Those are the numbers they take into account to qualify.
Right.
Now, in terms of going back
before you
to
go,
your
I just want to remind the folks, don't let your head go spinny on this. I'm sitting here talking to Narvik about this and realizing that some of these points and these numbers are just, they're flying around and I haven't been able to grab onto them. You may be in that same situation, but don't let that throw you. Send us an email, info@referencepointtv.com, with a specific question. We can get the right data to you. We can get you in touch with the people that can assist you if you're looking for some assistance in trying to understand how this stuff goes. Okay, so take me back. I've got these primary criteria. Okay, I can check off yes, 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 yes. What do I do now?
Right. Just to tag along, if the audience actually go to the makinghomeaffordable.gov and also hopenow.com, they're going to see some examples of these numbers that we're talking about.
Good.
Posted there.
That's useful.
But having said that, so now we know we have a $5,000 monthly income, and the 31% is $1,550. That's what we call in the finance world as the front-end ratio. That means that the $1,550 includes the mortgage payment, the property taxes, and insurance.
Okay.
Okay. There's also something that's called, we call the back-end ratio. And this is important because this is what actually determines the approval or the eligibility of the modification. The back-end ratio consists of the mortgage payment, the property taxes and insurance, plus any other financial expense the homeowner has. This includes credit cards, this includes car payments, anything that appears on their credit report, plus their household expenses, which is cable, phone, water, sewage, and so on and so forth. All of these numbers, the back-end ratio, cannot exceed, I want to say 85–90% of the gross income. So,
okay, so if that situation, if it does exceed that, then if you're going to go and try to get a modification, you've got to find some ways of cutting some of that stuff back.
That's correct.
Dump the cable TV, you know, whatever. But find ways of streamlining or reducing, if at all possible, that. Can you go the other route? Can you find a way to increase your income?
Well, yeah, it's a numbers game now. So either you have to cut your expenses, or you need to obviously have a higher income. I've seen folks who've really gone through the hardship and they had no choice but to maybe rent a room out for whatever the market rent was. The banks do accept that, but you have to provide proof. It's not one of those days where you could just state them.
Say,
they
hey,
will
I'm
ask
doing
for a
it.
rental agreement, proof of deposit, rent deposit, and all that. But that's also something that's taken into account. But ultimately, if all of your household expenses, including mortgages and all that, if they exceed your monthly gross income,
you're out of luck. You just, there's no way that you could qualify.
But if you're even $200 under or $300 under your monthly gross income, you have a relatively good chance at getting a loan modification. That's something a lot of homeowners fail to take into consideration.
Okay.
They just send all of their expenses because the banks or the lenders or the services don't dictate what you need.
Right.
They ask for pay stubs, they ask for bank statements, they ask for the information, you send it to them, and this is what they're looking at.
Ah, okay.
Okay, so if you're spending $500 a month on groceries, while under the hardship that you're at, maybe you should, decrease that amount a little bit. You should take all of those into consideration.
So instead of the Kobe beef, we get the,
right. Maybe you can go, with a sirloin or something.
Okay, we've got less than 10 minutes left in our show here. So I qualify for the primary criteria. My ratios are okay. Okay, my expenses are less than my income. My mortgage, after we get all the dust settles, is going to be 31%, no more than 31% of my gross income. What do I do now?
Well, now you have to initiate a call to your lender.
Okay.
Okay, the phone number is on the mortgage statement, and you call them and you simply tell them that, you know what, we are experiencing hardship and we'd like to see if we're a candidate for loan modification.
Okay.
What they'll do is they'll do a phone interview, and they'll ask for what your gross income is. They'll also ask for what your net income is. Net income is primarily taken from people who are self-employed.
Right. Is that what this request for modification affidavit form is all about? This is the sort of thing that they will fill out while you're talking to them on the phone?
So, yeah, as we mentioned in our previous segment, it's become so streamlined that you actually now the application form you get from your lenders is all the same. It just says Bank of America or
well,
Washington
that's useful because it used to be everybody had their own thing.
Right. And as I said earlier, it's because most of these lenders are trying to attempt a modification through the Making Home Affordable program because there are certain incentives set for them.
Okay.
But once they do go online, and a lot of these lenders will actually ask them to go online and
fill out the
fill
form.
out
Okay,
or
so you
print
could fill it online.
So this is what it looks like.
Or they might, ask you the questions and you can fill it out or whatever. But I guess you do have to sign it.
Right, you have to sign it, you have to fax it back to them.
It's a financial document, therefore it's a
But
loan.
it covers pretty much what we discussed, what the household expenses are, and you send this up along with certain documents they ask for, which is 2 months of bank statements and 2 months of pay stubs and tax returns. They'll let the caller know what documents they require.
All right, so you pull all your documents together, and then you send them, they'll already have the application, right?
That's correct.
Then you send the documents referencing the application number or whatever. They get this information. How long does it take? I mean, is this a process that it's going to be 6 weeks or 12 weeks before you know? Or
well, it used to be about 30 days, but now the volume has gone up so much. There are some lenders experiencing maybe 30 to 90 days of wait time.
Wow. Okay. So what happens to the homeowner during that time period? Are they going more and more in arrears?
Well, if they are late on their mortgage, because if you remember, we said that you don't have to be late on your mortgage to qualify. So if the homeowner is not late, they can continue making their mortgage payment while their file is being reviewed. Okay, so that really doesn't change much. But in terms of homeowners that are behind on their mortgages, then they will continue to be late. But the matter of the fact is that if they are on the verge of a foreclosure or whatnot, everything is frozen, comes to a standstill until a determination is made.
So because they have submitted the application and the supporting documentation, then no further action is being taken while their application is being reviewed. Okay.
But if for whatever reason the application is denied, then the foreclosure proceedings go back and pick up where they left off. So.
Okay, we've got just a few minutes left. Tell us what it is that I as a homeowner really need to do in order to give myself the best possibility of being able to qualify for a modification.
Well, it all boils down. 90% it boils down to what your income is. It's all about income. If you don't have an income, if you've lost your job, as I said, then there's a program for the forbearance where you can still call the bank and ask for a couple of months of forbearance until you find a job, and then you can request for a loan modification. But the
so you can do those in sequence then. Okay, that's good.
But it all boils down to the income. If your mortgage payment, as I said, including your property tax and insurance, are in surplus of 31% of your gross income, and your back-end ratio, which is all of your household expenses, are maybe a couple of $100 under the total, your gross income, you have a good chance. Okay. Just make sure you follow what the lenders ask you very, very accurately.
I think this has been really very useful for me to understand, and hopefully for the viewers out there. And I think one of this last summary that you gave kind of gives a simplicity to it. I mean, we've talked about some complexities in these last two segments, but that's the simplicity of it. Make sure that the income that you can claim and demonstrate is more than what your expenses are. Make sure the mortgage ratio is at a level that is acceptable to the programs. If you are in a situation where you've lost your job and your income has been is lacking for for a period of time, there's a possibility, there's a program so that you can get what they call it forbearance, which is sort of like letting it slide for a period of time until you get back on your feet.
Correct.
I know there's some limit to that, but you can get back on your feet, and then you can go for the modification campaign. This is something that you don't have to go pay somebody to figure out.
Well, no, it's something you can do. Now, as you mentioned, it varies from case to case. For some folks who are self-employed, it might be a little bit more confusing on how to gather the income and all that. It might not be a bad idea to, maybe partner up with somebody who's experienced in doing this.
And where I was going with that is that we talked about this in the last segment, how there are some people who used to say, pay me some money and I can get this job done for you. But I think what the point is now that there is enough complexity. If your mortgage is not likely to be one of the ones, especially one of the ones that would be a Fannie Mae or Freddie Mac, then it gets even a little more complicated. So finding someone that can help guide you through the process, like yourself, is probably a very wise thing to do.
There are HUD counselors, actually, they can contact. Every time you call for a loan modification, the bank, by law, is required to give you or provide the phone number out.
Okay.
They're also good sources. There are nonprofits who do these.
We actually need to wrap up because we've reached the end of our show again. And I wish we could go longer, but we can't. So, Narvik, I want to thank you again. Ladies and gentlemen, we've only scratched the surface here. There's a lot more detail that can apply to you. Send us an email at info@referencepointtv.com with your questions, and we'll be happy to get that information to you. So for Narvik and myself, I want to thank you for being out there in the viewing audience, and we'll see you next time on Reference Point.